We're talking today on the transformation roadmap for Indian banking. The transformation roadmap for Indian banking has become a lot more relevant in today's context. More especially in the context of the kind of experiences the economy and the banks are having. And what this means is, I would say more so in the last decade, the banks have gone through a lot of trying and testing times, which has been both good, bad, and indifferent for them. And the fact that the performance of the banking sector is directly linked to the performance of the economy. In fact, we say banks expose the entire economy to systemic risk. So if one bank fails, it has a rippling effect not only on the other banks, but on the entire economy. So with this context, keeping in view the kind of strains the banking sector has been facing in the last few years, because of a lot of events, we would talk about the transformation, reinvention, and the future of Indian banking industry. It's not a question of restart for the banking sector. It's a question of reset. And how that reset happens will determine the performance of the economy in the next few years. So if we are able to bring our banking sector to a little more stable scenario, I think that is going to go a long way forward in improving both the performance of the economy, our ranking and rating in the global context, and the perception about the international investors about how to invest in the Indian economy. Okay? So how do we look at this whole roadmap for the Indian economy? Yes, the Indian banks are transforming. We have seen a lot of mergers happen in the last 1 year. We have seen a lot of new changes in the banking sector. Apart from this, the Indian banking under the umbrella of our central bank, RBI, has never shied away from adopting the best banking practices. So way back, we had the Basel norms. And we are going to talk about these Basel norms. Now, these Basel norms at no point were mandatory for Indian banks. But RBI looked at these norms as best international banking practices. And once you look at them as best international banking practices, then what should stop us from accepting these norms? So to a great extent, way back, nearly about 2 decades ago, RBI has accepted, followed these best banking practices. More so in the last few years, banks have gone digital, which is also the need of the hour. Much before the pandemic also, we heard a lot of, changes which were happening to the infrastructure. So banks were trying to reach the remotest corner. So whether it was rural banking or investing heavily in digital technologies, we were trying to catch up with our global competitors, by not only in terms of infrastructure and other developments, but also by offering a complete gamut of wide-ranging, sophisticated services. Now, the move has come from the Indian government, and the move says that we will try and transform the country into a digitally empowered society that fulfills the support of rapid digitization of the Indian financial services. So the idea is reach the unbanked, reach the remotest of the backward and the backward sector. So, the whole focus has been to improve digitization and ensure that in the process, we improve the various services which are offered. And a direct result of improving the services would be to build loyal customers. The customer relationship management has become a really relevant area for banks to consider. A lot of research is also happening. What should a bank do to ensure that the customers remain loyal and remain with the bank? Not going into the details of the latest terminology we hear, which our Indian banks are also adopting. So whether it is an artificial intelligence, or it is digitization, or it is employing robotics, or it is automated selected banking processes, or machine learning, or big data analysis, all these are the various regulations, and the various banks are going out of their way to ensure that the Indian banks are fully capable in the next few years for employing these services. Okay. What happens by employing these new strategies? So it's let me put it as a digital reinvention and embracing these technologies so that the Indian banks are amongst the best, and they emerge as global leaders, and not only as global leaders, I would say, but also as strongest, stable, and dynamic banks in the world. Okay. The data reinvention, is also an important area which involves a lot of reconsideration. What could be the strategic initiatives, and how could we look at all these strategic initiatives from a customer-centric point of view? Okay. And in this context, the kind of changes, I would say, which has completely transformed the banking sector, from a bank which operated, let's say, from a 10 to 2 and 6 days in a week, you have a 24/7 banking service at your doorstep. So how do we ensure that the banking sector leverages all these technologies in the best possible manner? Two areas of risk which the banking sector will need to take care of. One is the cybersecurity risk, and the other is the risk management per se. So whether it's the liquidity risk, whether it's the foreign exchange risk, whether it's the interest rate risk, all these risks come along with all these tools which we have mentioned. So whether it's your AI or cognitive computing or other advanced learnings, all these will have to be adopted by the banking sector, in the context in which they are working. So this is a little about the digital part of the banks and how we need to be ensuring that whether it's a public sector banks or whether it's a private sector banks or it's a foreign banks, they need to be compliant with all these regulations. Okay? Not really regulations, with all these best practices which take them to the next level. Now, these are some of the environmental requirement which the banks need to take care. Coming to the flip side a little, the banking sector has been facing a lot of stress. They have been facing a lot of strain. And in a simple language, they have been facing a lot of strains on their spreads. There was a time when the banks used to work on margins. Now they are working on very thin margins, but on turnover. And it is in this context that we talk of customer loyalty. Because when your margins are thin, what is going to take care of your spreads? Only the turnover. And how do you increase your turnover? By having a good, loyal customer base. So how do the banks going forward adopt technology, sophisticated risk management tools? How do they ensure that they introduce complex products which increases their income? How do they ensure that there is cost efficiency? And how do they ensure that ultimately all this ensures in the soundness of the banking system? Okay. This is a very interesting slide, and honestly, I really wanted to start my lecture with this slide. But with so much of digitization happening, if you don't start with an AI and with a machine learning and with big data, you feel you have missed out something. Now, coming a little to the evolution of our banking structure. I read this quote somewhere many years back when this whole transformation of the Indian banking sector happened, more so after 2000. Very senior banker was asked to comment on the changing role of banks in the last many years. And it's not even a scenario of today, a few years back. And he summed it up very aptly in his interview. He said, if I were to summarize the role of the banks and how they've evolved the last few years, in terms of the evolution, our banking sector has evolved from armchair bankers to lazy bankers to crazy bankers. And I could not resist from entering this, that after COVID, honestly, we have super crazy bankers. So we talk of frontline workers. I would say our banking staff is also frontline, who have worked entirely during the pandemic, entirely during difficult times. So how do we justify what we are saying? Banking sector has evolved from armchair bankers to lazy bankers to crazy bankers. So armchair was sometime in the 60s and the 70s when a banker, in a more literal sense, was sitting in his chair. What would he do? It would be more like, okay, you give me the check, I'll enter your passbook, all those details. To get a draft made would take, let's say, 2-3 days. And if it is 2 o'clock or 10 minutes to 2, the shutters would be done. In the morning at 10, no. The bank will not open at exact 10. It will be 5 minutes past 10 or 10 minutes. Or even if it opens, there'll be some cleaning or some other thing. So without any offense made, the sector was a little laid back. So that is what armchair banker. Come 1990, it evolved slowly to lazy bankers, which means they started working. So I'm not saying the banking sector was not working. I'm implying in the kind of products that were there, the kind of environmental requirements that were there. Okay, so there was a scenario of lazy bankers in terms of the whole environment. And after 2000, we have had crazy bankers. Now, what this means is that prior to 2000, you didn't have a lot of complex financial products like your futures and options and swaps and a lot of derivative instruments and super complex instruments. All this has meant that the banking sector works, I think there is something to say, more than 24/7 also. 365, 366 days in a year. They're working throughout because the kind of changes which have happened, let's say more so after, let's say 2000, the housing sector, there was a mismatch in their assets liabilities. And this resulted in an asset liability mismatch for the housing sector. And what happened was they realized that till now, we were only looking at the liability side of the balance sheet. The asset side is also equally important. And when you look at the asset and the liability side, there will be an asset liability mismatch in terms of the loan rollover. Not going into the details again, because asset liability mismatch is again a full topic for discussion, which a lot of us would be knowing since we are from the commerce and the management background. So the crazy bankers meant that one person could be dealing with real estate loans, could be dealing with any other sector loan. He would also be dealing with a swap. He would also be, dealing with some derivative financial instrument. He would be dealing with all the functions. And then after COVID, yes, we have had super crazy bankers. Okay. Now, what are the challenges? What is the transformational or the transformation roadmap for Indian banking? I've just highlighted three. The non-performing assets and this whole, what we have been reading very recently, which came up by our respected finance minister in the very recent budget speech. The role of non-performing assets and bad banks. Then about off-balance sheet financing, which I would have mentioned very briefly. And then about the international best banking practices in terms of the Basel III rules. So very briefly highlight Basel I and II and how prepared are the Indian banks. Please remember that the soundness of the banking system is what ensures that the entire economy remains sound. So it is in that context, we are going to talk about the Basel rules and the best banking practices which have come up as a result of the adoption of the Basel rules. Now, what is a non-performing asset? What is a non-performing asset? When an asset ceases to generate income for a bank, it becomes non-performing. So the assets which are there in the balance sheet, when you read the asset side, we are assuming they're generating income for a bank. And that is why since 2005-06, banks have been asked to classify assets into 4 categories, which is the classification of the non-performing assets. In fact, related to this is another classification which talks about rate-sensitive assets and rate-sensitive liabilities. So an NPA is an asset for which interest or repayment of principal has not been paid, or it remains outstanding for a certain period of time. And Indian banks do recognize that if there are huge NPAs in their book, they lead to the problem of, and they impact the profitability, liquidity, spread, and the functioning of the bank. But yes, the fact remains that NPA is the biggest challenge which the banking sector is facing. And that is why I've given this quote by the RBI governor, about maintaining the health of the banking sector remains a policy priority. Because this is what will help us in ensuring the stability of the financial system. Yes, no discussion on NPA is complete without mentioning the present scenario we are in. It's a black swan event, you know. And why do we call it a black swan event? Because it was assumed that all swans are white till a black swan was discovered. So this is a black swan event because, you know, it doesn't happen every year. It's happened after 100 years. And if anyone had given a warning, maybe we would not have taken it so seriously. So the first wave and the second wave, there are differences in the two also. So the second wave has been a little more harsh or much more harsh, and it has impacted the economy, which was slowly coming back. So since April onwards, everyone has been impacted by the COVID pandemic, and it has impacted the various sectors, because of which the NPAs have further gone up. You know, so there were a lot of extensions given by the banking sector for loan repayment, and a lot of them have been extended also because it has impacted the entire functioning in terms of the net profit margin, the profitability ratios, you know, the various ratios for a bank, the return on assets, the return on capital employed, and all this has been negatively impacted and have come under severe strain. We were just mentioning on the categories of NPA. So banks are required to classify their NPAs into 4 categories. One is standard, which is good. Substandard, I've just added this slide just for more for academic purpose. I'm sure each one of us would be knowing the classification of NPAs. So you have standard, substandard, doubtful, and loss. Loss is the most risky out of these categories. So doubtful also. So the idea is, when you prepare the balance sheet, you classify your assets like this, so that even if your balance sheet says assets worth 100 crores, and let's say standard assets are only 20%, we know that it is a cause for worry. Why do we have these high NPAs? One, there is a twin balance sheet problem. You know, this twin balance sheet problem, which is a term which has been phrased after the 2008 crisis. And what does the twin balance sheet problem is? Twin balance sheet problem is when both corporates and the banking sector are reeling under financial stress. So both corporates and the banking sector, both of them are reeling under financial stress. So corporates are facing problem because they're not able to repay the NPAs. And the banking sector is already facing a stress because a lot of companies are not repaying the loan. So keeping this in view, you know, there was this term which said a twin balance sheet problem, and that is what is resulting in a high NPAs. Then, I mean, I did not really go into these details of frauds of very high magnitude. There have been frauds of very high magnitude in the last decade. So whether it was the Kingfisher or the PNB or the IL&FS crisis, for each one of them, there were certain agencies which were responsible for indiscriminate lending. And in fact, if I explain these 2 points together, you know, the reason for these frauds of high magnitude was the aggressive and indiscriminate lending which happened by the banking sector. Some of it was, you know, intentional, some of it was non-intentional. So in some cases, the companies went into issues because of the, let's say, the environmental issue. Like it could be the 2008 crisis or the kind of scenario we are witnessing. In some cases, you know, and without taking any names, there were frauds of huge sums, which nobody can recover. It's only that the banking sector has to take a haircut. And during the current budget speech, our finance minister had thought about these, and they said, what should be the solution? And let me also add here, the rating of India, which Moody's had given as Baa3, and the important reason they mentioned about our low rating was India's banks are a cause of concern. And I think it's towards this end that we have a lot of mergers also which have taken place. So per se, the lending, which has been indiscriminate, and the strains which are being felt. So if I just mention here, your MSME sector has also faced a lot of strain. So a lot of companies under the MSME, they may not be able to repay the loans due to the pandemic, due to the contraction of the economy. And all these bundled together make it very difficult for the organization, for the banking sector to move forward. I was only reading somewhere that frauds to the magnitude of about 2.05 trillion have happened in the last 11 years. Now, somebody is going to bear the brunt of these frauds. Somebody is going to suffer. Somebody is going to take a haircut. So how do you solve this problem? And the fact also remains that the banks, by virtue of their incorporation, by virtue of their charter, or the banking sector, is not trained to run after recovery of bad loans. They are trained to do the banking business. And if they are running all the time after the recovery of bad loans, I mean, it's definitely going to impact the whole, the working of the banking sector. So this gives a lot of stress to the banking sector. So to help clean up the balance sheet, this was one of the suggestions given by, our finance minister during the budget exercise. Please remember, this is not the first time that this suggestion, has been given to have a bad bank. The suggestion was given by the Indian Bankers Association even much earlier. Much earlier, they had also given the suggestion that, we must have a bad bank. But at that time, it was still in the process of thinking, I guess. So they're pondering over the issue. Should we have a bad bank or should we not have a bad bank? So let us give you a little idea about a bad bank. If it's a bad bank, we can start this by explaining a bank selling bad loans. Do you think it's feasible? Do you think a bank can sell bad loans? Yes, it is feasible with the proposal to set up a bad bank. So what is a bad bank? A bad bank, works something like an asset reconstruction company. I'm not sure whether you are aware of the concept of securitization. But please remember that the concept of the bad bank is to help the banks clean up the balance sheet and the situation which has intensified because of the pandemic. And it has completely impacted a lot of sectors across the board. So what is this concept of a bad bank? The concept of a bad bank works like this. Let's say there are 5 public sector institutions. They have bad loans worth X amount. So these 4 or 5 public sector banks join together with their own representatives, and there will be a bad bank. So I've said public sector banks. So the whole thought is that there has to be, the government push towards the creation of a bad bank. What will happen is that this bad bank will be created, which will then buy off the loans from the existing public sector banks. So which means, if you take an example, so let us say there are 4 banks, A, B, C, and D. A has bad loans worth 100 crores, B has worth 200 crores, C has worth, let's say, 400 crores, and D has worth 300 crores. So there is a bad bank which is set up, which has been set up to only buy these loans and help these banks get over a temporary liquidity problem. So please remember, the bad bank is only going to work towards the resolution and the recovery of the assets over a period of time. How does it happen? So what will happen is that this bad bank will buy, okay, let me go back to the slide only. Okay. So what will happen is, so what I want is, I want to explain the process and then show you the slide so that, it helps us in understanding the concept. So this bad bank will buy these loans from these 4 banks, A, B, C, D. Now the question which one of you can ask is, why should the bad bank buy loans from bank A at 100 crores, B at 200, and so on and so forth? They will not buy the loans worth exactly the same amount. There has to be some haircut. So let's say this bad bank buys these bad loans from A worth 100 crores at 80 crores. So that is the settlement which is going to happen between the 2 parties. This 20 crore is a loss which the original A bank will have to tolerate. So let's say A is a state bank. They will have to take a haircut worth 20 crore. And this bad bank now gets this loan worth, or this, bad loan worth 80 crores. The same process happens for the others. What will be the next step? The next step will be that this bad, obviously there are parties who have defaulted. I hope you understand, there are parties who have defaulted. And the second point, for a lot of these loans, there will be some mortgages. Okay, so there are 2 dimensions which I'm emphasizing. There will be some party which has defaulted, and there will be some mortgages. What this bad bank will do is, whose only job is recovery of these bad loans. The bad bank will then try and recover these loans through some process which has an acceptance or a yes from the various regulators. Okay? So the process in summary form is that a bad bank is created to help the banks clean up their balance sheet, transfer these loans to another bank, and then do your normal banking business. And this bad bank, who has only got these bad loans, for a haircut, then tries to recover as much as it is possible. There is a flip side to this, which we will also help you understand. So the process. This structure of the bad bank was proposed by the Indian Bankers Association, and the whole process was to buy toxic assets from a good bank at a price below their book value. So remember, this is the example I had also given. So wherein if it's worth 100 crores, you buy it at 80 crores. So the bad loans will be transferred below their book value. Whatever, could be the less provisions, could be a little more than less provision. The next step will be to sell these stressed assets to prospective buyers at arm's length principle. Now, this bad bank will try and recover, or remember, when we talk about an asset reconstruction company, remember I started by saying an asset reconstruction company. Asset reconstruction companies have only been formed to recover these bad loans. So the asset reconstruction companies, the only job they have is to take these loans at a haircut and recover through various means. I mean, I'm not going into the means which they could be used. The point is, rather than having 100 crores in your balance sheet as a non-recoverable, at least you have recovered 60, 70, 80 amount. Okay. Recovering then, yes, is a significant challenge, but that's the only way, or let's say that's the only way forward. So what will happen? Banks will be able to focus on their normal banking business, for which they have been formed. They'll be able to do the normal lending and borrowing business. This would also help us in improving our credit rating because the balance sheet is clean. And all credit rating agencies look at the balance sheet of a bank, or the balance sheet of at least the big banks before they lend. And you should be in a position to better mobilize the capital from the market. And more important, it will ensure the stability of the economy and the banking systems. Okay. At no point, we are suggesting that the bad bank is going to be like, what should I say? It should be a structure which is a permanent structure. No, it will be a structure which is only formed to help the banks get over this temporary problem. Okay. Now, these suggestions which I am giving you, this is both for bad banks and to help bad banks get over the NPA. So the problem is, just by transferring the bad loans from one book to the other doesn't solve the problem of bad loans. There are a lot of rules and regulations which have to come. So there is going to be a lot of accountability and responsibility. So it's not that you keep giving the loan, you keep having the bad loans, you transfer it to a bad bank and they keep struggling it. No. The point is, there has to be look back and look forward. So both reactive and proactive. Creating a bad bank is a proactive approach. But the reactive approach also has to be there. You need to get wise after giving loan to a party why it went wrong. So you need to improve your corporate governance, give more powers to banks to recover NPAs. As of now, I've heard the rules are such that even if you have a mortgage with a loan, you cannot sell off that mortgage. There are so many legal hurdles to sell it. And I'm sure you would know whether it's a Kingfisher or the other cases, how much we are struggling with the loans. And you just visualize the kind of interest which is mounting on that loan. So it's better to take a haircut, move forward, rather than to keep struggling with it. But yes, you have to give more powers to banks to recover NPAs. And yes, nobody can re-emphasize or doubt or think again about an efficient system of credit appraisal. You have to have a system of credit appraisal, whether it's a model, whether it's a process, whatever you do. But there has to be a stringent requirement. I remember, with this whole bad loans, about 2-3 years back, a little more than that, there's this program on television where they had called all the chiefs of the bank, whether retired or not. So even if they retired 10 years back, they were called and they were asked to explain